It's time now for your call sheet, where we look at the topics driving the trading day ahead. Crew members today, Peter Bookvar, 1 Point BFG Wealth Partners, is back with us. Also joining us, Ryan Dietrich, Carson Group. Peter and Ryan are both CNBC contributors. And Amy Wu Silverman of RBC Capital. It's great to have you all here. Peter, I'm going to kick this off with you, and I'm going to pick up on what we were talking about with Henrietta Trace just a short while ago, and that is Iran peace push, and specifically what we've seen. There's a cool chart from Ben Emmons, friend of the show, if we could pull that up. But we've seen the inverse relationship between Brent prices and the number of times war ends soon is mentioned by the president or the administration. So how does that set us up for this moment right now?
I'm hoping this one is for real and we do get a resolution to this. I don't think either side's going to get exactly what they want, but the inflation is the global pain point and we need some relief. We need some relief at the pump, and I think this is what's going to get us there. I think it's still going to take time for the Strait to fully reopen, for supply chains to normalize, but we need to take this big step to get there first.
Yeah. Amy, what's the options market signaling about all of this?
You know, it's been fascinating because the options market this entire time has been overwhelmingly exuberant. We've seen historic levels of call buying. And really, despite everything that has been going on geopolitically with the Strait of Hormuz, with the impact we know will happen down the line, there's been very little downside protection put in place and very little hedging.
Yeah. Ryan, I want to get your thoughts on this, especially because it does seem like there have been two sort of big tent poles that are moving the market one way or the other on a daily basis. There's Iran conflict being one and AI being the other.
You're right. Good morning, everybody. Hopefully everyone had a nice Memorial Day weekend, and thanks for everyone who keeps us safe out there. So you guys had a great conversation before I came on. Let's build on some of these things here. We know tech is leading, right? We know that. But I think what's fascinating, most people might not realize, Morgan, if you look year to date, 6 sectors are actually outperforming the S&P 500. Just last week, the S&P 500 equal weight hit an all-time high. Of course, the Dow finally got back above 20,000. I'm sorry, 50,000. And you think about it, I mean, this is not just this is a broad market, right? I keep hearing how it's only tech going up. Yes, tech is up more than most things, but it really is, Morgan, a broad market. And we think that's pretty healthy for a continuation of this rally.
Yeah. Meantime, Peter, I mean, inflation front and center in this market as well. And we've seen those gyrations playing out in the bond market, too. We had services inflation that was elevated and sticky ahead of this conflict. Now we've obviously seen the knock-on effects of energy price spikes as well. And then, of course, we were talking about this with a guest earlier in the hour from PIMCO. Even if you get a conflict resolution here in the near term, the strength of this AI infrastructure build out could also mean very strong growth and could also keep inflation stickier. So how do you navigate it?
I think it's that, and I think commodities generally going to have a bid. I mean, for the next year or two, you can just imagine the amount of stockpiling, the strategic reserves that are going to be created for more than just crude oil, but for a variety of different commodities. And I think supply chains are not going to be quick enough to catch up when things normalize. So to me, commodity prices are in a bull market, commodity stocks are in a bull market, and that's going to complicate the inflation story for the incoming chair. And it's going to keep at least long-term interest rates still elevated, and I still risks for them to move even higher after this recent move higher.
Yeah. Amy, I want to throw up a chart from Kalshi here. And it basically is how high will the S&P get by month end, which, keep in mind, a couple days from now, right? End of the week. But 68% think we're going to end the month of May above 75.50 for the S&P, 49% above 75.75, and 29% above 7,600. I mean, it really speaks to perhaps, as you just mentioned, the bullishness that we see in this market.
For sure. And I can tell you that when we look at option tenors, maybe through year end, the bets that are similar, saying that we will be over 8,000, 8,500, look somewhat similar to that as well. I think it really speaks to the momentum in the market. And one thing we've learned over time, if you just think about April 2nd of last year, the drawdown we had, but the whiplash back up, there's a lot of fear of the right tail, Morgan. There's fear of missing out, and there's fear of being caught offsides, not necessarily on the downside, but on the upside that you then have to explain to your investors if you are a fund who didn't get that upsiding, didn't get that right tail.
Yeah. Ryan, I want to go back to something you just said, and that is the broad-based nature of this rally that we're seeing, particularly with, equal weight S&P at a record last week, Dow at a record last week. where do we go from here? I asked that question. I know it's like, but I'm asking it because so much of the narrative this week, other than Iran, is going to be around whether this tech trade can continue when you look at some of the names that are going to report earnings.
Well, I want to build on something that Peter just said here. We have a new Fed leadership, right? We know that. And when you look at history, and a lot of people have talked about this, I just dug in though. The last 100 years, within the first 3 months, you have as much as a 12% on average peak to trough correction. Do markets truly test new Fed chairpersons? Listen, the last 3, they really didn't. But history says you could. So let's just be aware of that. After an 8-week rally up 17%, the second best 8-week rally in history, maybe you get a little test. And where's it going to come from? Like Peter just said, higher commodity prices, potentially higher yields. That's a big theme we've been saying all year at Carson Group. Inflationary growth. We're not super worried about inflation running 3.5%. We've said it probably would this year. Yes, commodities aren't a bull market, but we still think it's a equity bull market. Now, to specifically answer your question, I think you stick with the cyclicals. I mean, tech is way up there. We get it. But industrials, financials are the worst performing group. I think they're going to have a big second half as cyclicals kind of continue to take this baton here, Morgan.
All right. Peter, we've got less than a minute here. Final thoughts.
I think it's a tricky moment because the AI dominance has sort of pushed aside other things. If you look at retail earnings last week, comments from Walmart, where they said for the first time since 2022 that the average person is filling up less than 10 gallons, it tells you that there's still this very stressed consumer that needs relief on the inflation side and why it's so important for the strait to reopen and supply chains to begin to normalize again.